What if you could tap into the secrets of Warren Buffett, one of the most successful investors of all time? How does he consistently achieve impressive returns and outsmart the market? In this video, we uncover Buffett's strategies for making 20% returns by diving into his timeless investment principles. From focusing on business fundamentals to maintaining patience and avoiding market noise, we'll break down the key elements that can help you replicate his success. Let's get started. Number 1. The Golden Rules of Investing. Warren Buffett's investment wisdom is anchored in two golden rules: don't lose money, and don't forget rule number 1. These rules emphasize the critical importance of capital preservation. According to Buffett, protecting your investments from loss is more crucial than seeking high returns. The idea is to invest in assets priced well below their intrinsic value, creating a margin of safety. This margin cushions against potential losses and reduces the risk of capital erosion. Buffett's approach teaches that by focusing on minimizing losses rather than chasing returns, investors can safeguard their wealth and increase their chances of long-term success. This disciplined mindset ensures that even if markets become volatile, your investment base remains secure and resilient. Number 2. The importance of temperament. Warren Buffett often highlights that successful investing requires not just intelligence, but also the right temperament. According to Buffett, a stable and disciplined mindset is essential for navigating the ups and downs of the market. Investing isn't about being swept up by market trends or emotions. It's about staying rational and focused on long-term goals. This means resisting the urge to follow the crowd or react to short-term fluctuations. Instead, investors should rely on careful analysis and remain steadfast in their strategy. Buffett's emphasis on temperament underscores the value of maintaining a level-headed approach, making decisions based on facts rather than feelings, and staying committed to your investment principles even amidst market chaos. Number 3. The advantage of staying away from Wall Street. Warren Buffett's preference for staying in Omaha rather than Wall Street offers a strategic advantage. By avoiding the hustle and bustle of financial hubs, Buffett sidesteps the constant noise and short-term distractions that can cloud judgment. Wall Street's high-pressure environment often leads to overreaction and speculative behavior, which can skew investment decisions. In contrast, Buffett's calm and isolated setting allows him to focus solely on analyzing the intrinsic value of businesses without external influence. This tranquil approach fosters deeper, more rational investment analysis and helps him avoid the pitfalls of market hype. By maintaining distance from the frenetic energy of Wall Street, Buffett ensures a clearer perspective and a more disciplined, long-term investment strategy. Number 4. Focusing on the business, not the stock price. Warren Buffett advocates for investing with a focus on the underlying business rather than the stock price. He believes that the true value of an investment lies in the performance and prospects of the business itself, not in daily stock price fluctuations. By evaluating a company's fundamentals, such as its earnings, management quality, and growth potential, Buffett ensures that investment decisions are based on solid long-term metrics. He views stock prices as secondary to the intrinsic value of the business. This approach helps investors avoid being swayed by short-term market movements and ensures they are making decisions grounded in the actual health and potential of the company rather than speculative price trends. Number 5. Understanding your circle of competence. Warren Buffett emphasizes the importance of staying within your circle of competence, the areas where you have the most knowledge and expertise. By focusing on industries and businesses you thoroughly understand, you can make more informed and confident investment decisions. Buffett advises against venturing into unfamiliar sectors or trying to invest in things you don't fully grasp. This approach minimizes the risk of poor decisions and helps you recognize valuable opportunities within your area of expertise. For example, Buffett has avoided technology stocks not because they aren't promising, but because he doesn't feel he understands them well enough. Adhering to your circle of competence allows you to make smarter investments and manage risk more effectively. Number 6. Valuing businesses accurately. Warren Buffett stresses the importance of accurately valuing businesses to make sound investment decisions. This involves analyzing a company's financial health, earnings potential, and overall economic environment. Buffett believes that before investing, you should determine the intrinsic value of a business, which is the true worth based on its fundamentals, rather than relying on market price alone. He advises using metrics such as discounted cash flow analysis, profitability, and growth potential to assess value. By comparing this intrinsic value with the current market price, investors can identify undervalued opportunities and avoid overpaying. Accurate valuation helps investors make informed decisions, ensuring that they buy businesses at a price below their true worth, thus creating a margin of safety for their investments. Number 7. The patience to wait for the right opportunity. Warren Buffett's investment success is partly due to his patience and discipline in waiting for the right opportunity. Buffett believes that finding a good investment is not just about timing the market, but rather about waiting for the right conditions. He often refers to this as having the patience to wait for the fat pitch, opportunities that meet his stringent criteria for value and potential. Instead of jumping on every available investment, Buffett remains patient and holds cash until he finds a business that offers significant value at a fair price. This patience allows him to avoid impulsive decisions and capitalize on high-quality opportunities when they arise. By being selective and patient, Buffett ensures that his investments are well-timed and aligned with his long-term goals. Number 8. Learning from mistakes. Warren Buffett views mistakes as valuable learning experiences rather than failures. He believes that acknowledging and analyzing your errors is crucial for growth as an investor. Buffett advocates for a reflective approach where you review past decisions to understand what went wrong and why. By dissecting mistakes, you gain insights that can prevent similar errors in the future. This process of continuous learning and adaptation helps refine your investment strategy and improve decision-making skills. Buffett's ability to learn from mistakes and adjust his approach has been key to his long-term success. Embracing mistakes as learning opportunities rather than setbacks fosters resilience and enhances your ability to make better-informed investment choices moving forward. Number 9. Applying Buffett's principles to your investments. To achieve strong returns, you can apply Warren Buffett's principles to your own investing strategy. Focus on long-term value by investing in businesses with strong fundamentals and holding them over time. Stay within your circle of competence, concentrating on industries you understand well. Avoid being swayed by short-term market noise and focus on the intrinsic value of your investments. Exercise patience by waiting for the right opportunities and avoid rushing into decisions. Learn from your mistakes and continuously improve your investment approach. By integrating these principles into your strategy, you can enhance your investment success and work towards achieving impressive returns. Incorporating Warren Buffett's timeless principles can transform your investing approach. Focus on understanding the intrinsic value of businesses, remain patient, and avoid short-term distractions. By adhering to these strategies, you can make informed decisions and achieve sustainable returns. Remember, investing is a long-term journey, and following Buffett's wisdom can guide you toward financial success and stability. Thanks for watching. If you found these insights valuable, don't forget to like, share, and subscribe for more insightful content. Share your thoughts and questions in the comments below. We'd love to hear from you. Goodbye, see you in the next video.